Okay. Oh, yes. Before I forget, as usual, as we all know, we do this sessions every Tuesday morning and at 6 a.m. London time every Tuesday morning. And then we have another session tomorrow on Wednesday at 6 a.m. Toronto time. Whatever that time is, I think that's midday Rwandan time, which would be 11 a.m. Nigerian time and 10 a.m. UK time. Excuse me, but I guess we can figure that out. So yes, we have this session every Tuesday morning, 6 a.m. London time, every Wednesday, 6 a.m. Toronto time, because we have some traders from Canada who are just going to be joining us. But of course, everyone is welcome to attend both sessions. So you can attend any of the sessions. They're there on the platform. So it's open to everyone on the platform. So you can join the Tuesday morning sessions and also the Wednesday session. So it's there. You can register for both of them. You're welcome to attend both of them. But anyway, the real reason why I'm bringing that up is that I try my possible best to make the Tuesday sessions and the Wednesday sessions as much as I can. But obviously, because of some of the other commitments I have with my businesses and the charity, I might miss some sessions. So it's just to remind everyone that I try as much as possible to make all sessions and not schedule meetings or stuff during those times, but sometimes it's unavoidable and I might have to miss some of the sessions. So for example, tomorrow I have to go to the villages in the morning. We're going on a field trip for the charity. I'm hoping I'll be back by midday to do the session tomorrow, but I might not make it. Same on the Tuesday morning session. Sometimes I have to leave home 6 o'clock in the morning to go to other parts of Rwanda. So I'm just highlighting that fact that sometimes I might miss some of the Tuesday sessions or the Wednesday sessions. But I try and make as many as possible. If I'm going to miss them, I'll post a note on the platform. But just to let you guys know that, yes, sometimes I might not be able to make all the sessions. Okay, let's get on with today. So the markets we're looking at now are the Euro US dollar and the dollar Canadian dollar. And we're looking for reports of high importance and noting reports of medium importance that are due out today that could affect the euro, the US dollar, or the US Canadian dollar. So let's have a look. Of course, I'm using the Rwandan time zone, GMT +2. So you use your own time zone wherever you are. So today is Tuesday, the 23rd of March. So let's see what's coming out. Of course, you can just completely ignore the reports of low importance. You can just completely ignore them. So the first report of high importance today is at 9 o'clock Rwandan time. 9 o'clock Rwandan time, we have the UK employment change report. Basically, it's unemployment figures. So the employment change report is due out at 9 o'clock Rwandan time. And again, this will directly impact the UK stock market and currencies paired with the pound. So the UK stock market and currencies paired with the pound will be directly impacted by this report. But because UK is the financial capital of the world, it could indirectly impact other markets, other countries, other stock markets, and other currency pairs. So because of that, it's better to err on the side of caution, both for the Euro US dollar and the dollar Canadian dollar, to wait till 9 a.m. this morning before you trade. which is just under an hour's time anyway. It's going to be announced shortly. So, like I said, UK, this would directly impact the UK stock market and currencies paired with the pound, but because of UK being the financial capital, it's best to be cautious and avoid trading other currency pairs, including Euro US dollar and dollar Canadian dollar, prior to this report. So let's see what else is coming out. Again, we can ignore all these reports of low importance. We can ignore Brazil, ignore all those reports of low importance. There's a report of medium importance here at 3 o'clock Rwandan time from the United States. Is the US Fed Bullard is going to speak. It's classified medium because it's someone from the US Federal Reserve that is speaking, one of the board of governors. So it's just a speech. He's not making an economic announcement, but because it's from the US Fed, it's classed as medium, just to be aware he's speaking. But they usually are very guarded with their statements. They're very vague because they know the impact of whatever they say. So they're very careful what they say. So just to know that someone from the US Fed is going to be speaking. It's not an economic announcement, and they don't usually say anything crazy. So that's why it's classified as medium. So you just note that around 3, it might be a good idea to check your markets and check your trades around that time, but it rarely affects the markets because they rarely say anything to spook the markets. Then at 4 p.m., Rwandan time again, out of the United States, we have the new home sales. Anything to do with the housing market could potentially affect the markets, potentially, not usually, but could potentially. So it won't stop you from trading, but it will be a good idea to check your trades around that time. As we all know, it was the US housing market that triggered off the global financial crisis in the US and globally. So sometimes this can affect the markets. But again, it's not a report of high importance. But again, that's why it's good to note reports of medium importance, because it gives you an indication of when to check the markets. Again, as a day trader, you don't have to be glued to the screen all day, watching the market all day, but you do need to check your trades intermittently, because as you know, the market is up and down all over the place. So you might be taken out of your first trade. You might need to assess the market to place your second trade, or the market might move 30 pips. You might need to move your stop loss. So there are reasons why you need to check your trades intermittently during the day. But, this also gives you an indication of when to check your trades, checking out the reports of medium importance. Not all reports of medium importance are significant. You can ignore some of them. But like I said, things to do with the housing market out of the United States is something to note. Like I said, all this won't stop you trading, but you note that, okay, let me just check my trades around 3. Let me check it around 4 o'clock. Just have a quick look, see what's going on, to see if these reports have any impact on the market. Again, you can see this is some more people from the US Fed speaking. And again, like I said, it's not important because they never say anything untoward, because it's just a speech and not an economic announcement. But you could just have a quick sneak peek at the market around those times. Of course, you could just ignore the reports of low importance. And again, this is just a reminder, now that I'm talking about times to check the markets. So just remember that 24-hour market cycle. So you know that the markets start at midnight with the Asian market. So you can really start trading from midnight, like Bola showed you last time. So if you're up at midnight like Bola, you can start trading from midnight technically. Obviously, if there's no public holidays, no reports of high importance, if it's clear for you to start trading from midnight, you can start trading from midnight. Because when the Asian market is open, they will be trading all of the markets. So you can technically start trading from midnight. But again, like I said, you still need to check for the economic calendar, holidays, and the rest. Okay, so like I said, 5 o'clock, 5 a.m., the Asian market is closing. So this is beginning to close. And then about 6 o'clock, the European market starts to wake up and cause activity in the markets. And again, like I said, that's why we're doing this session at 6 a.m. UK time. Oh, by the way, all these times are UK times. These are all UK times I'm using. These are all UK times. So wherever you are, you convert it to your own time zone. And again, you know, on the 20th of April, the clocks will be going back or forth. I don't know what is happening on the 20th, whether it's going forward or backward. So always check. But this just gives you a rough idea. So from midnight to about 5 a.m., the Asian market is open. The market is active. 5 a.m., the Asian market starts to close. 6 a.m., the European market comes in. So ideally, we should be doing our session at 5 a.m. So we're ready for 6 a.m., but that will be too early for people. So that's why we're doing it at 6 a.m. this session. So that's the rationale behind having this morning session, 6 a.m. UK time, so that we are ready before, because usually by 7 a.m., the European market is then in full swing. And then 8 a.m., the UK market comes in. Now, this 8 a.m. when the UK market comes in, because there's to be a huge influx of traders into the market, it could either push the market up, down, so there might be a spike in activity. So this might be a good time to check the market, so check your trades around 8 a.m. UK time, because you know that's when the UK market is opening, and there might be a flood of traders taking positions, and they might change the direction of the market or push the market in the same direction. So that's a good idea or good time to check your trades when these UK people enter the markets. Then at 2:30, again, remember these are all UK times. At 2:30 p.m., the US market comes in. So again, the US market, when they come in, they could start pushing the market in one direction or changing the direction. So again, it's a good idea to check your trades around that time when the US market is opened, because they could cause activity in the markets. So that's a good time to check your trades. And then, as you know, 4 p.m., the UK market is closed. And then at 9 p.m., the European market and the US market is closed. So as we know, at 9 p.m. UK time, all stock exchanges around the world are closed. And then between 9 p.m. and midnight, they're all closed. And at midnight, all this starts again. And again, that's why we stop trading at 6 p.m. because we know that from 6 p.m. the market will start to wind down towards a close when they all close at 9 p.m. Okay, so again, this is where being aware of this major stock market opening times, it gives you a good idea when to check your trades during the day as a trader. So it's a combination of checking your trades around 8 a.m. when the UK market opens, 2:30 when the US market opens, and then also checking your trades, using these reports of medium importance as to a good time to check your trades. Obviously, reports of high importance, you just want to avoid trading completely prior to that report of high importance. Okay. So let's get back to today. So today, we're going to avoid trading prior till this report at 9 a.m. Rwandan time, which is in about 45 minutes. And, we'll place our trades just before that report. And then, like I said, you check your trades again around intermittently. Then also at 2:30 when the US market comes in. And then also during these reports of medium importance that could potentially affect the market, but they rarely do. But it's good to just quickly check 3 o'clock, 4 o'clock, and obviously 10 past 4 or 5 when this Fed chaps are speaking. Okay, so that's another board to add to your string. Okay, so as usual, you check the rest of the week. And again, usually when you're checking the rest of the week, what you're looking for are the major reports like interest rates. That's the one you're really looking out for when you're checking which reports of high importance are coming out the rest of the week. So it's usually, for example, when you're trading the euro US dollar, you're really worried about if the US, obviously the US interest rate decision would affect all markets. So that one definitely you want to be very careful trading that week leading up to, during the week, the US interest rate comes out. You want to be careful trading any market during that week prior to the US interest rate decision, and also the US unemployment rate reports, which come, the non-farm payroll report, which comes out on the first Friday of every month. So those are really the two biggest reports you're checking out for, is the US interest rate decision being announced this week, or the US unemployment rate report being announced this week, and you want to be careful trading prior to those reports. So those are the two biggest ones you're looking out for when you're checking the rest of the week. Now, and that would affect all markets. Then, of course, specific to Euro US dollar, you're also looking for European Central Bank interest rate decision. So you want to be careful trading that week. The European Central Bank interest rate decision is coming out when you're trading the Euro US dollar. And then things like the Canadian dollar now that we've added to it, with the Canadian interest rate decision has been announced, you want to be careful trading that week. Okay, so those are really the main reports we're looking out for when we're checking the rest of the week. Now, you see, the reason why I'm emphasizing that is that this week, we don't have any of those reports I've just mentioned coming out this week. So I could go ahead and have 3 attempts today, 3 attempts tomorrow, 3 attempts every day this week, because as we'll see, what we have is a UK inflation rate report. Yeah, it's still of very high importance, but that won't stop me having 3 attempts today if I need to. We've got this US durable goods orders, Germany. So yeah, you have some reports of high importance, US GDP growth rate. So although there are some reports of high importance coming out this week, but they're not high enough or worrisome enough like those ones I've mentioned, interest rate decisions and the US unemployment rate, to stop me trading or having 3 attempts each day this week. And of course, you don't just have 3 attempts blindly. Obviously, you take each trade on its own merit. Okay, so let's get back to today. So today, we're just going to keep away from the markets, place our pending orders just before that report at 9 p.m. and then see what, take it from there, see what happens. Okay, and then obviously you check market watch, see if there's anything causing uncertainty in the markets. And again, like I said, that's the beauty about trading currencies. It tends to be major global news that affects the currencies. Most of all these things have to do with the stock market. So if you're trading the stock market, and in fact, that's why trading has a bad name, because the stock market is too sensitive on a daily basis to all this news. And that's why trading gets a bad name, because people who trade the stock market, they're glued to the screen all day. They're watching the news closely all day because the stock market is sensitive on a daily basis to all this news. But that's for trading. But of course, from a long-term investment point of view, you don't have to worry about all that. So for those who've done the investing course, know that you don't have to be worried about all this on a daily basis with long-term investing. But from a trading point of view, that's why it's not a good idea to trade stocks. They're too sensitive to all this news. Whereas the beauty of trading currencies is that they're not sensitive to all this crazy news about the stock market. So what you're just looking for is whether there's a US shutdown of the US administration, whether there are trade wars with China, whether Joe Biden has fallen ill, whether North Korea is beginning to rattle the cage, So yeah, basically nothing major going on. So, and again, there are no public holidays in the UK or USA today. So we're basically free to trade today from 9 o'clock this morning. So let's look at the charts. So we can start with the dollar, Canadian dollar, start with the swing trading. So you can see this is a daily time frame. The market, you can see, is obviously trending down. And like I said, I use the moving average 100 for the euro, for the US Canadian dollar. And I, place my pending buy order, because my plan is to buy if the market changes direction, breaks the moving average and starts to go up. So that's what my plan is, to buy when that happens. So I keep moving my pending order every day with the moving average till the market breaks that moving average and takes my order, which could take weeks or months. So all I just do every day is just check what's the moving average today. Look at the data window. The moving average 100 today is 1.2719. So 2 pips above that is 1.2721. So I just modify my order to 2721. Modify my stop loss to 100 pips below 2621. So that's it for my swing trade till tomorrow. So let's go to day trading. So I drop down to the 5-minute time frame. So we can see at the moment, the the dollar, Canadian dollar, the USDCAD is currently trending up. You can see it's broken R1 and the moving average is here. Again, remember, you're trying to sell somewhere below the moving average and buy somewhere above. So at the moment, we can see the market is trading up, it's broken R1. And so the only place to buy above the market at the moment is R2, which we cannot use using the pivot point strategy. So there are no buy opportunities. Again, you can't sell here below R1 at the moment because R1 is above the moving average. You can only sell somewhere below the moving average. So at the moment, the potential place to trade would be to sell below the pivot point. But again, I'm not going to place that order till just before the report at 9. So that's where I'll potentially be trading come just before 9, is to place a pending sell order just below the pivot point. Of course, again, always remember the market is dynamic. You make your decisions based on what you're seeing at the market at that time. Because in a couple of hours' time, if the market is still going up and the moving average now goes above R1, and then at that point, I could move my sell order from below the pivot to below R1. But at this point in time, I just have to base my decision on what I am seeing now. And what I'm seeing now is that the moving average is below R1. It's above the pivot point. I can only sell somewhere below the pivot point. So the only place I can sell now is below the pivot point. And there are no buy opportunities. Let's go to the Euro US dollar. So start with the daily time frame. Again, we can see the Euro US dollar is trending down. Again, moving average today, again, this is moving average 50 I use for Euro US dollar. Moving average today is 2039, 1.2039. So 2 pips above that is 2041. So I'll just modify my pending order to 2041. Also my stop loss, 100 pips, 1941. So that's it for the swing trade till tomorrow. And then drop down to the 5-minute time frame for day trading. So again, we can see initially the market was trending up and started to trend down. Then you can see that spike there and then it went sideways. And then you can now see it's moving down haphazardly. But you can see it hasn't broken the pivot point yet. So if we're lucky, if the market is still above the pivot point just before 9, we can place a sell order just below the pivot point to sell, because again, you can see the pivot point here is below the moving average. So we can sell below the pivot point and then have a pending buy order just above R1, which is above the moving average. But again, I won't place my order just yet. Wait till just before 5 minutes before 9. And if the market is still looking this way, I'll place a sell order just below the pivot point. Of course, if 5 minutes to 9 comes and the market has broken the pivot points, then the only choice I'll have left is just to sell below S1. So we'll see what it looks like at 5 minutes to 9. And again, I'll post my trade on the platform. Okay, so that's the plan. Any questions? If you have any questions, my fellow trader Bola.
Yes, good morning, everybody. I do have a question.
Go ahead.
And it's about what you have just said now. So what you have said, of course, I can see that the moving average, based on where the moving average is, that we would potentially place a trade under the pivot point. That would be our entry point.
Yeah.
But equally, when we look at where the market is now, it is still fairly close to the pivot point.
Yeah.
And I remember on previous sessions, we have said that when there is a report likely to come out, that we try not to trade too close to the market, because the reports can come out and all sorts of crazy shenanigans could go on, where it could just take our order, spike up, spike down, and we could lose our order. So I'm just a little bit confused about that.
Okay, that's a very good question. And this is why trading is not an exact science. You have to judge for yourself. So when I've said to judge for yourself, this is why trading sometimes is just down to experience and you observing things. So let's look at this closely. So if the report is about to be announced, and this is where the market is, this candlestick here, yeah?
Mm-hmm.
Now this is too close for me. Now, I'm going to say a lot of things now, just to show you that there's really no clear-cut answer.
Okay.
So this is too close for me, but this is fine. Now, also, because this report is really due out from the United Kingdom, and it's going to just indirectly impact the euro-US dollar. So that's why, again, I'm also not too worried. Whereas for the pound dollar, because with the pound dollar now, you can see the pound dollar is already acting crazy, because this report is going to have a direct impact on currencies related to the pound. So with the pound, because of that, I'm going to be slightly more cautious.
Okay.
With the pound. So yes, it's really a combination of just trying to size up every situation. So with the pound here now, yes, one is going to be very careful, because you can already see it's now jumping up and down, because in half an hour that report will come out. So even with this pivot point here, I might be a bit, you can see there's still quite a good distance, isn't that right? But I'll still be actually cautious placing a buy order above this pivot point with the pound, because I know it's going to be crazy, because this is going to directly impact it. But because it's not going to directly impact the euro-US dollar, just indirectly, I'll be happy to go with that. But again, it's also judging how far the market is. There isn't a exact number of pips. It's just you saying that this is too close to me. This is not too close. So yeah, it's just weighing pros and cons and doing the eye test, which comes with experience.
So basically, I guess it's understanding a whole raft of factors, saying what exactly is the situation today.
Exactly.
Exactly. Hard and fast. What exactly is going on today? Okay,
exactly.
This is likely to be, okay. Oh, you're almost kind of having to make a judgment call.
Exactly, exactly. And I like what you just said, and this is what I always say, that's why, in fact, that's the biggest reason why we had to add this sort of sessions after the course, because as you can see, once we do the course for 5 weeks, it's very difficult to explain every scenario because trading is not a textbook thing. Trading is a dynamic thing, it's not textbook. So it's difficult to explain certain things until you see the scenario. But yes, the course gives you the basic information, the basic foundation, the basic tools, but it's the application that is really where the practice and the experience comes in. So just like you rightly said, and you said perfectly, is that each trade, you take it on its own merit. So before you place, so just like I said now, although we can technically have 3 attempts today, yeah, but each attempt, you need to stop, think, weigh all these, weigh every circumstances available before you place that trade. So each trade, you have to take it on its own merit.
Yeah, myself and Bola, because she's also on this call as well. We did that yesterday. We placed a trade. I think we placed a sell trade, and we were all taken out of the market. And we looked at the market, and funny enough, without even discussing with each other, we both said we weren't. Even though we knew we could trade, 3 trade, we both said no, we're not. We looked at the market. Well, I looked at the market, and I thought I'm not trading again. That's enough. That's enough for one day. And she did exactly the same thing. So it was interesting when we came together and discussed it.
Exactly. Yeah. Which is exactly what I too did yesterday. Well done. So it just shows you that that's what you need to do as a trader. You just have to. So the fact you could have 3 attempts doesn't mean you should just go blindly and have I have 3 attempts, because just like you two did yesterday, when I sent out this thing yesterday, at the time the market was trending sideways. I placed my sell order below the market support. There were no buy opportunities, and the market just kept going up beyond R2, and I just left it alone. So like you two did, like I said, at the end of the trading yesterday, like I said, I had no live trades on Euro US dollar today. So yes, you're well done, both of you, because yes, if there are no opportunities, there are no opportunities. You take each on its own merit. So the fact you can have 3 attempts doesn't mean you should just force it. So yeah, well done.
Okay, thank you.
Pleasure. So yeah, so everyone, that's the lesson, is that you take each trade on its own merit. So for example, today, come 9 o'clock, which is half an hour's time now, if you place a sell order below the pivot and a buy order above R1, in fact, that is why we always say that when the market takes one order, you delete the other pending order. That's the reason we say that, because for example, if I place a sell trade here, the market falls, takes my sell trade, I'll delete the buy trade. And again, just like we just said, that's the reason. The reason why we delete the buy trade is that if I lose out on this sell trade, I need to then assess what is going on in the market, then decide where I'm going to place my new pending buy and sell order, judging what is going on in the market at that time. So that's why you don't want to leave pending orders hanging around, because
Thank you very much for that, because I have been guilty of that, and I never kind of understood why you did it, but now that makes absolute sense, and I will not be doing that, because I've been doing that, but I won't be doing that anymore. That makes absolute sense. Thank you for that, actually.
Pleasure. And but yeah, like I said, Bola, you are becoming a master trader.
I need to earn I need to see the money coming in. I need my bank account to swell with this master trading.
No, but the good thing is that this is the good thing about trading, is that, the first thing is to learn all these things you're learning, Bola, and everybody, is to first learn all these mistakes with 500 pounds. Because as you all know, is that the way you then make money, because once you've learned all these little tricks, these little things, and you're now being able to assess the market well, assess everything on a well basis, and you feel very confident, then as you know, you can then maybe start trading with maybe 1,000 pounds or 2,000 pounds in your account, and you can now start trading multiple markets, which is what I do. So now you again have more opportunities to catch moves in the market, but obviously, again, don't forget, you still need to apply good money management. So this is what we discussed in this money management part 2, which is always there for you guys to watch over and over again. So that's where you can now start making real money. Yes, you're not going to make real money with 500 pounds or $500. But the reason why I say you start trading with 500 pounds or $500 is that make your mistakes, learn your lessons with a little bit of money, see how you feel when you lose money, because like I said, you're going to have losses. How do you feel when you have your losses? Are you disciplined? Are you consistent? So the aim is to have that pressure, that fear with real money, but not too much, just £500. But you're still in the learning phase. You're still learning all these things that you're learning. Why are we deleting our orders? Why are we doing this? Why are we doing that? Analyzing the market. So once you now feel that, okay, I'm pretty comfortable with what I'm doing. I'm now aware that trading is high risk. I'm now aware there are losses involved. I'm well aware of the importance of money management, discipline, checking the markets, analyzing each trade. You know how to analyze the charts. Once you've done all that and you're comfortable, then you start trading multiple markets with good money management, and then you can put in more money into your account, and then that's where you can start. In fact, you just see how, this is the beauty about trading multiple markets, because you can see Euro US dollar is trading sideways today, pound dollar is trading sideways, dollar yen, all this are going sideways, but you can see this one fell. Aussie US dollar, you can see that one fell. So you can see this New Zealand dollar, that was a huge fall. So
How long does this take you to do every single morning? My goodness, because you've got loads.
No, again, that's why I'm saying that you need to start by knowing what you're doing well. So, for example, if you know what you're doing well, it takes you very quickly to analyze the market, because now your eye is so trained. I can easily tell, I can sell here, buy there. I can easily tell here that when the market is open, I can buy there. There's no sell opportunity quickly. Here, I can easily tell this is sideways. This is within the sideways trend. I can buy there, sell there. You can tell here, okay, this is broken the pivot point. I can only buy there, sell there. The dollar yen, this one, you know that, okay, I can only sell there. This one now is trending sideways. I can buy there, sell there. This one now has dropped there. I can only buy there now. So again, you can see once you know what you're doing, it's very easy to analyze the market quickly. And again, this only, like I said, this comes with experience, because also placing orders, you can also place orders very quickly because you know what you're doing. Obviously, because when I'm trading, I'm not teaching, I'm just trading myself. So I can just say, okay, EURUSD, I'm going to sell there, bring up my order, just do your sell trade. Because I'm not teaching anybody, so I don't have to be slow. I can just go ahead and do my orders, and you move on to the next one and just move on. So within 10 minutes, I'm done or less. So yes, but again, that speed and that analysis quickly just comes because you know what you're doing. Your eye is trained. You know how to assess the market, the reports, which reports you're looking out for which currency pair, blah, 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 and you just move on. But like I said, all that comes automatically once you've known how to master one or two markets, and because like I said, the 3Ms, that's the beauty about trading again. As you can see, the strategy is the same. The analyzing the market is the same. The money management is the same. So the only key now is, do you know how to apply, when to trade, when not to trade, what report, when to check the markets. Once you can master all that, it's the same thing you apply to all of them. Because even you can see here, this is the Aussie 200, the Australian stock market index. Again, it's the same thing. You can see it's trending sideways, so there's no swing trade opportunity. If you go to M5, again, you can see it's now trending sideways between the pivot and S1. So again, it's still the same strategy. When I go to the S&P 500, again, same strategy. You can see it's hovering around the pivot point. So the strategies are the same, whether you're trading indices, which is the Dow Jones, the FTSE 100, the DAX. The strategy is the same, whatever currency pair. The key is just, do you know what you're doing? Are you applying good money management? Are you analyzing the market? Are you trading at the right time? So the principles apply to all the markets. They're the same. I'm using the same strategy, the same thinking. It's just that, yes, I know when to trade, when not to trade. I can quickly analyze the market because obviously from looking at charts for 20 years. I can just quickly look at the chart and tell
Mm.
exactly where to put my trade and where not to put my trade. I think it's just because when I'm teaching people, that's when I'm drawing lines and taking my time. But when I'm trading on my own, I just need to look at it quickly and I know where I'm trading straight away. I know what is sideways, I know what is trending up, I know where the sideways trending, where the moving average is quickly, and I know where to place my trade. I don't have to start drawing lines.
It's funny enough, to be honest with you, the drawing line, sometimes I find that confusing. I just kind of look at it and I
Exactly.
look at
But but because I'm teaching, I can't do that. I have to be clear what I'm doing because I'm teaching. But you're right. When I'm trading myself, I don't bother. As you can see, you don't see lines on all these charts. I can't be bothered.
I try. I do it because you suggested it, but sometimes I'm like, it's to the eye now. I can kind of see where this thing should be going. But it's okay. Let me follow Dr. Remi's advice.
Yeah, but that would be irresponsible for me if I tell people just to use their eye when they're just. But in fact, like you are discovering all these things, they come automatically with practice and experience. So yes, now that you begin to be good at analyzing a chart, yeah, you don't have to use a line. Your eye is okay. But yeah, I can't do that teaching because you don't know what level people are to say just use your eye. But yeah, you're right. As you get experience and you practice and you know what you're doing, you can adjust all these things to suit yourself. If you find the lines are inconvenient and you know what you're looking at, you don't need to use the lines. But yes, as a beginner, it helps people know clearly where that sideways trend is. Because like now, if someone is new to trading and they switch off their computer and come back 3 hours time, they might be confused. Oh, where's that sideways trend again? But if they have the white lines there, it's clearly demarcated for them. So it's just making it easy for them. But yes, you're right. With time, you do what, once you master what you're doing. And again, that's why I keep saying is that the whole aim of these sessions is not to make people dependent on me, because the more and more experienced you become and you know what you're doing, you might just say, oh, just ignore me. You don't need to listen to me anymore. Because like I said, the aim is for you guys not to be dependent on me, is to start making your own decisions. And like I said, Bola is a good example of that. She's been trading for midnight without my permission. She's using her eye. So that is the aim. It's not to be dependent on me. It's that once you know how to apply all these principles, you don't have to wait for the sessions to place your trades. You don't have to wait for my posts to do what you have to do. Because like I said, the aim is just to make sure you all know what you're doing, give you the opportunity to ask questions, see what I'm doing, ask questions. But the aim is for you to all be making your own decisions yourselves. So yeah, well done, Bola.
Thank you.
Keep using your eye.
I goes to make money, not to lose it.
Any other questions?
Yes, I have a question.
Go ahead. Okay, go ahead. Let's start with Shegun.
All right. Hopefully it's not going to be a long one. Right. I have just set myself up on a PC finally. I was using my son's one and I've bought my own now.
Okay.
Set everything up and I just found out that I find it difficult to place pending orders. I don't know why. What I've...
Okay, can I look at your screen?
Okay, I'll share. If you let me share, then
yeah, so I'm giving you permission to share. So let me stop sharing mine.
Can you see my screen?
Yes, I can sort of see half of it. Okay, I see all of it now. Okay. All right.
So I've got quite a few set up from, this is how I had it before. I have set it up now here. And so I just found out that when I want to, just doesn't let me place pending. I don't know why.
Okay, let's go to the Euro US dollar. Let's go to the Euro US dollar.
Okay.
And double click on your, I can't see your trading platform. The trading terminal, the one at the bottom. You know where you see your balance?
Oh, okay.
Double click on that. And then click on trade. Go to trade at the bottom left.
Okay, yeah.
So that way you can see that way you see your orders here.
Yeah, okay.
You set a limit order, which is wrong. So select that, right click and delete it. Delete. The yellow button. Now you can see the ticket is up there.
Oh, okay. Right.
Okay. Now let's start from the beginning. All right. So luckily the report is going to be announced shortly. And in fact, you can now see that the market is getting too close to that pivot point. So it might, but let's go ahead and place the buy trade, because we can easily place buy now above R1. So let me see you do that. Actually, do you have a notepad on your computer?
I should have.
Okay, so bring up a notepad if possible, because we're going to do it systematically. Like I say, it's always important to do it systematically to start with, and then later on, things can speed up.
So, yes.
Okay, it's not showing up on the screen, but that's okay. Because what is R1? So let's first identify what is R1. What level is R1?
That's 1.19608.
So you can round that up to 1961.
1.1961.
Okay, so that's R1. So if R1 is 1.1961, at what level do you want to buy?
That's 1 second. You want to buy 2 points above that.
Good, yeah. So that would be what?
That's 1.1963.
3, good, brilliant. So that's going to be your entry point. So if you're buying at 1.1963, what would be your stop loss?
Stop loss would be minus 20.
Good, which would be what?
That's be 1943.
Good. And then what will be your profit limit?
Plus 60.
Yep. So that would be what?
Oh wow.
So that will be 1963 plus 60. So if you have a calculator there, you can do 1963 plus 60.
2003.
So yeah, so that 2003. Okay, good. So now that you've figured out all those, you can now, let's come to the other ticket. So place your order.
So I'm placing
Pending, good. And then, like I say, ignore all those limit orders. If you're buying, you select buy stop. If you're selling, you select sell stop.
So I'm doing a buy stop.
Yeah, and at what price do you want to buy?
It's 1 good second.
Sometimes you can also get a piece of paper and write it on a piece of paper.
Yes, I can.
Yeah, so I said the key is just to make trading easy for you. Do what is easier.
Yes, so it's 1.196.3.
Okay, stop loss.
Stop loss is 0.1943.
And then take profit.
Sorry.
That's okay.
2003.
Good. And then you can set it to expire at 6 o'clock. So 1800. Okay, and then click place.
Okay, that's good. Oh wow.
Yeah. Yeah. Let me see your chart again. Your screen is half screen.
Can you see it now?
Yes, I can see it now. So you can now see that if you just do it systematically and step by step, you can see it's no problem.
Okay. Thank you very much.
Pleasure. Because usually I know when people have odd problems placing an order, it more often than not tends to be because you missed a step somewhere.
Yeah. Okay.
So you can see it's just a question of just going through each stage one by one. Where's my entry point? At what level? Where am I buying? Where am I stop loss? Where's my profit limit? Then you do the same with your order ticket. Make sure it's a correct order pending. If you're buying, you select buy stop. If you're selling, you select sell stop.
Awesome.
And then you can see
Thank
everything.
you very much.
Pleasure. So you can leave your order there. Then let's see for the, let me go back to my screen. I think we're about to.
I'll stop sharing now.
We're about to. Actually, Abimbola, you can ask your question.
Okay, I had, good morning. I had,
Morning.
there were two questions I had really.
Go ahead.
One, I wanted you to explain the gap. There was a gap.
Ah, yes, well done. Thank you for, you know, I had that in mental notes to talk about the gap. Oh, well done. God bless you. I'd completely forgotten. I had a mental note I was going to discuss the gap. And
yeah, because I didn't quite understand what did that mean? Did everybody go to sleep and not?
No. I will explain shortly because I'm so happy you brought that up because I had made a mental note that I'm going to use us as a teaching point and I've completely forgot. So thanks for that.
Great stuff.
That's the problem of making mental notes at this age.
You need to write it down. Get your
exactly.
pen and paper.
Exactly.
My other question was, so I use the pivot point strategy a lot more, but what I should be doing is trying to incorporate the moving average.
Okay.
And I don't use it as much. So I know you explained a bit about the trading being below the moving average and then placing your order near the pivot point or just below the pivot point. But I just wonder if you could take a bit more time to just explain, go over again that moving average and your strategy there.
Okay, no problem. We'll do that once we place our orders. The market is about to hopefully give us some money. Okay, so you can see, going back to our eye test, like we discussed with Bola, you can see when
I use the horizontal line, so I don't do eye test.
So you can see initially when Shegun was looking at his chart, you saw the euro fell, and I was saying, "Oh, it's getting too close to the pivot point." Yeah. And now, but you can see it's gone back up. So now I'm still going to use the pivot point. So that's why I'm saying that you just have to keep making a fluid judgment. So now that it's shot back up, I'm going to now place a pending sell order below the pivot point on 1.1916. Because I rounded that up to 1918 because that's 5. So 2 pips 1916, 2 pips 1.1936. And then again, I can't do mental maths. I have to get out the calculator. So that would be 1916 minus 60. So that's 1856. So 1.1856. Good. So I'm ready for the report. So you can see it's now 5 minutes to 9. I've got my pending buy order just above R1, pending sell order just below the pivot point with my 20 pips stop loss, 60 pips profit limit. Then let me do the same for the, well, I've already got the order there for the Canadian dollar. What did I do? Oh gosh, see, that's why I shouldn't do things in a hurry. I did the wrong stop loss. It's just, I'm selling at 2509. So it should be 2509, 2 pips below, 2509, and 20 pips, it should be 29. So 20 pips will be 2529, and take profit is 2509. 2509 minus 60, 2449. So 1.2449. There you go. And then for pound dollar, again, you can see, use the pivot point. There's no sell opportunities. S1 has already been broken. and I can't use S2, that could potentially be a market support. Let's see. So this low here is, don't worry, we're going to get back to you, Bola. Sorry, Abin Bola. Let's see. So this low here is 3820, 3820. So that's low and 5. Okay, so you can see this low here is 2820. So this is actually a market support. So we have a market support there. Oh, I'm sorry. Don't trade the pound dollar, please, unless you know what you're doing and you've got good money management. Please don't do that. But that's the market support. So I'm going to sell just below the market support. So that'll be 1.38, sorry, 1.3818. 2 pips below that, 3818, 1.3838. And then the buy will be just above the pivot, that's 3851, 3853. 1.3853, 1.3833. There we go. Okay, so now we can answer your question, Abimbola. We'll let the market do what it wants to do now. We've decided where we want to trade. Mainly the one we're doing is the Euro US dollar and the dollar CAD. And for the USD CAD, there are no buy opportunities. The market hasn't formed the market resistance. It's hovering around R1. We can't use R2 to trade, so there are no buy opportunities. We can only sell, and we can sell below the pivot. That's the other part, the first opportunity below the moving average. And then the Euro US dollar too, we can see it's hovering just above the pivot point. So I've got sell order just below the pivot point, buy order just above the R1. Okay, let's go to gap. So yesterday in the market, we can see that the market gapped. Actually, let me see if we can actually see it on the chart itself. There you go. That's it there. Okay. So this is where the market closed on the 19th of, actually, let's measure it. So look at the data window. So this is the 19th of March. Let me bring up a notepad. So this is where the market closed on the 19th of March, Friday, 19th of March. So on Friday, the market closed, and you can see look at the close. So it closed at 1.1904, 1904. So market closed one, oh, I've forgotten what it was. Okay, close 1.1904, 1.1904. So the market closed on Friday. So Friday market closed at that level. And then when the market opened on Sunday, the 21st, because it opens on Sunday night. So when the market opened on Sunday, the 21st, it opened, again, we're looking at the opening level. It opened at 1.1878, 1878, 1878, 1.1878. So the market closed on Friday at 1.1904 and then opened Sunday night at that level. So again, like I said, I don't do mental maths. So 1904 minus 1878. So that's 26 pips. That's not too bad actually. That's 26 pips. So there was a gap of 26 pips on opening. Okay, so that's really what a gap is, but I'm going to talk to you about the significance of that. So you can see the market closed at that level and then it opened at a different level when it opened. So there's a gap. So there was no, you can see there's no price. Between this and this level, there's a huge gap there. Luckily, it's just a gap of 26 pips. So there's a gap. So there's no price. So that means the market, and of course, because it's open there, it gapped down. So that's why I call it gap down, which is what I said in the post, that the market gapped down because it closed at one level and it opened at a lower level with a gap in between. So it's literally that gap that is called the gap. So it's gap, and that's because it went down. So that's why I say now say gapped down. Now the significance of this is that usually when the markets close on Friday, it's closed. So there's no market activity over the weekend. But something could happen over the weekend that could affect the market. So there could be bad news, something may be happening in the world that, you know, and the markets cannot react till it opens on Sunday. So when it opens on Sunday, there might just be a huge reaction and there might either be a huge buy or a huge sell, and then the market will gap and there will be no price because there's just this jump in price. And then we saw the opposite for pound dollar. I mean, for USDCAD, we saw the opposite. Where is it now? Okay, that's it. So we can see with the US CAD, it gapped up. So for the CAD, it closed at that level on Friday and then jumped up. There was this gap up. But you can see these gaps are not too much. But that's what tends to happen, is that if there's a lot of activity over the weekend, the market can gap. There can be a gap where there will be no price. So it's just the market reacting to whatever happened over the weekend, and that's the first opportunity it can react, is when the market opens. Now, the significance of this is why, you know, I always tell you guys, you should never take a day trade over the weekend. And this is the reason why you should never take a day trade over the weekend, because the market could gap when it opens in the morning. So, for example, let's just assume you were in a live trade on Friday, day trade, and don't forget you're only using 20 pips stop loss for a day trade. With the swing trading, you're using 100 pips. So that's why you don't mind leaving your swing trade to run over the weekend, because you've got a lot of allowance. But with day trade, you're only using 20 pips. So let's just assume you're in a buy trade here, just like in this Euro US dollar. Let's assume you entered the market at, let's just assume you entered the market at, maybe you bought at, let's assume you bought at 1.1914. So let's just assume that was your buy level. And you left, so you had your stop loss at, so you had your stop loss at 1.1, oh, let me get the calculator out. 1914 minus 20. So that's 1894. So you had your stop loss at 1894. Okay. So like I said, we're just taking a scenario. So you enter the live buy trade for day trade at 1914. Your stop loss at 1894. You left it running. The market closed at 1904. So you at least you were losing 10 pips at the time the market closed, but you were still in the trade because your stop loss was at 1894 and you're risking 20 pips. Now, when the market opens on Sunday night, because of this gap, the first available price was 1.1878. So the market will not take you out at this level. It would not take you out at 1894. It would take you out at this level. So you'll be taken out at this level because this is the first available price. This is the first available price. So this is where you'll be taken out. So instead of you losing 20 pips on this trade, you would then lose, much more than 20 pips.
So it ignores your stop loss.
Exactly.
Wow.
That is why I say you should never take a day trade over the weekend, because this phenomenon tends to happen over the weekend. It can gap. So that's actually why I made a mental note to talk about gap. And again, thank you, Abimbola, for reminding me, because this is the reason why I always stress never let a day trade go over the weekend. Because if you leave this trade and the market closes, you can't even delete the trade. You can't close the trade. Once the market is closed, you cannot do anything to your live trade. It's stuck. You're now at the mercy of the market. If you don't close this trade and delete it before the market is closed, your live trade, you're stuck there. You can't do anything over the weekend. And then once the market opens, so again, let's use this example. You bought at 1.1914. So you bought at 1914, and you are now taken out at the first available price at 1878. So on this trade, you will lose 36 pips. You will lose 36 pips because that's the first available price. Now, like I said, this is not a bad gap. Sometimes if there's war declared over the weekend or something catastrophic happens over the weekend, or Joe Biden falls ill over the weekend, something catastrophic happens over the weekend and you're now stuck in a live trade. You are now going to be praying that the market doesn't gap against you, because sometimes you could see a gap of 100 pips. You can see a gap of 50 pips. You can see huge gaps sometimes if something terrible happens over the weekend. And if it's against you, you're going to lose a lot of money. So that's why I said I wanted to mention that. So this is the reason why you never take a day trade over the weekend. These gaps, they rarely happen during the week when you're trading. That's why I'm comfortable letting my day trade run from Monday to Tuesday, or from Tuesday to Wednesday, or from Wednesday to Thursday, from Thursday to Friday. But on Friday, I definitely close all my day trades because of this phenomenon. Because if the market gaps against you, your stop loss is of no consequence. It will take you out at the first available price. And if you're unlucky, that first available price is like 50 pips away or 70 pips away. Yeah, that's what you're going to lose. So this is the reason why I always stress never ever let your day trade run over the weekend because of this gap that could happen. Obviously, if it happens in your favor, you can make a lot of money, but of course, that's gambling. So as a trader, don't gamble on that happen of it going in your favor. Always err on the side of caution and just close your day trade on Friday before the market closes. But of course, we always say our day ends about 6 p.m. So about 6 p.m. on Friday, just close all your live trades, close all your pending orders, shut everything down. But obviously, your swing trade, you can leave that alone. But for day trading, close everything down on Friday evening, because once the market closes on Friday night, if you have a live trade in place, day trade, you're stuck. You cannot modify it, you cannot edit it, you cannot close it. Once the market is closed, you're then stuck till the market opens. And if it opens and it gaps against you, that's what you're going to lose, irrespective of your stop loss, because it will just take you out at the first available price. Okay. So that's why I keep stressing to you guys, never ever let your day trade run over the weekend. And you can now see why. What was your second question, Abimbola?
Thank you for that. The second question was around the moving average.
Okay, yes. Oh, by the way, like I said, let me just emphasize again, these Tuesday morning sessions I've set aside, giving time to answer as many questions as possible, even if it takes us 2 hours. Same on Wednesday. I've set the time to spend as much time as I can. Everybody's welcome to attend the Tuesday and the Wednesday sessions. Again, I might not be able to attend all of them due to my other commitments. But the other thing I want to stress is that, of course, if you have to go to work, you have to go to your business, you have other things to do, by all means, you can log off at any time. You don't have to stay to the bitter end. You'll feel free to log off if you have to get on with your day. As usual, the recording will be posted on the platform. So I just want to stress that. Because like I said, I have dedicated this time. I'm happy to answer questions till there are no more questions. I'm happy to be on the line for 2 hours or 3 hours if need be. But everybody else, you don't have to. If you have to go to work, get on with your business, do whatever, you have other commitments, by all means, log off and you can catch up on the recording. So I just want to stress that. And also, that's why I don't want to put anyone under pressure. So if you still have more questions, don't think you're wasting my time. If you have more questions, you can go ahead and ask. If you have to log off and get on with your day, by all means, log off and get on with your day. Okay, right, let's talk about moving averages quickly. Actually, Abimbola, I'll get you to unmute yourself because I'm going to get you to answer these questions to get you to understand it. Because that's the best way. Okay, let's talk moving averages. So this is the market in black. And then the moving average here is in red. So we're going to go through this together, Abimbola. So Abimbola, what's the relationship you can see between the market, which is black, and the moving average in red? How do they relate to each other? Tell me.
They're both going in the same direction.
Good, number one. What else?
They overlap at they kind of, so when they're going up, they overlap, and then when they're going down.
What happens when they overlap?
They change direction.
Good. So when the market is going up, when it crosses the moving average, it changes direction. So if it crosses it, it changes direction. So this helps you understand what I'm doing, the swing trading, because you can see when the market is going up, if it crosses the moving average, it tends to fall. So you could potentially sell there. If it's falling and it goes up and crosses the moving average, it tends to go up. So you could potentially buy there. If it's going up and it crosses the moving average, it tends to fall. So that could present you with trading opportunities. If the market is going up and it crosses the moving average, you can sell because you know it tends to fall. Not always. You don't use the word always. And then if it's falling and it crosses the moving average, it tends to go up. So that could be potential opportunity to buy. So you can now see that's what we're doing with the swing trading. Okay. What else do you notice, Abimbola?
Not quite sure.
And you're not allowed to call a friend. You're not allowed. You're not, that's why I stressed that out. You're not allowed to call a friend. Because you asked the question, so I'm going to get you to figure it out as much as you can by yourself.
Okay, so when it's trending up,
good, yes.
It's below the moving average is below the market.
Good, well done. You see, that's why I wanted you to figure it out yourself and not call a friend. Well done. So when the market is going up, is what above?
It's above the moving average.
Good. When it's going down, where is it?
It's below the
good.
Moving average.
So long as the market is going up, where would it be?
Below, above the moving average.
Good. So long as the market is going down, where would it be?
below the moving average.
Good, well done. Let's stick to that now. Well done. So if you see this happening, where's the market going?
The market is trending up.
Good. So long as the market is above the moving average, where is it going?
Up. It's trending
Good.
up.
And what are you looking to do when the market is going up?
Buy.
Good. Well done. Let's go the other way. So if this is what you see, so long as the market is trending down, where is it?
It's above, the market is below the moving average.
Good. And if it's going down, what do you want to do?
You want to sell.
Good. Okay, well done. So long as the moving average is below the market, it's going where?
It's trending upwards.
So if the market is below the moving average, is trending upwards, and you're looking to do what? Buy.
To buy.
Okay. So now let's take it a step further. So if the market is here and it starts to fall, are you happy to place a buy order, I mean a sell order here?
Not yet, no.
Why?
Because it hasn't crossed the moving average.
Exactly. Exactly. Now you're getting it. Let's now go to the platform to see what we said. Let's go back to the platform. So, like we said here, where's the moving average?
It's below the market.
So where's the market going? Up. Just like you said, so long as the market is above the moving average, where is it going?
It's trending upwards.
Would you like to sell somewhere above the moving average?
Well, yes. Oh, I don't know.
No, you just said it. You see, it's interesting when you do the diagram, it looks straightforward. When you come to the chart, you said, so you can see it's exactly the same as the chart. You said you don't want to sell here because it hasn't crossed the moving average. So you don't want to sell around here. Isn't that what you said?
Yeah.
So that's exactly what's happening here in this scenario. You don't want to sell anywhere here because it hasn't crossed the moving average.
Got it.
Isn't that right?
Yeah, got it.
So you only want to sell when you know the market has crossed the moving average. Isn't that right?
Yeah.
Exactly. So that means you want to sell somewhere below the moving average.
Got it.
So that's why I said the pivot point is below the moving average. That is why you're going to use that to sell. So again, let's see if we can find another example. Okay, but that's usually you can't find examples in real life when you want them. But that is why we said that as a general rule, you want to make sure your buy order, when you're placing a pending buy order, it should be somewhere above the moving average, and your pending sell order should be somewhere below the moving average. But it's going from this principle, which you got correctly, because you know that if the market is above the moving average, it's going up. If the market is below the moving average, it's going down.
Going down.
And then if it crosses the moving average, it will change direction. If it crosses, it will change. But if it doesn't cross it, for all intents and purposes, it's still going up because it's above the moving average until it crosses it. So that's why you want to make sure if you want to place a sell order, it should be somewhere below the moving average. If you want to place a buy order, it should be somewhere above the moving average. So you could just, let me summarize. So your buy order should always be somewhere above the moving average, and your sell orders should always be somewhere below the moving average. So let's get back to the charts. So if you see the trades we've just placed today, You can see that's the moving average. You can see our sell order below the pivot point is somewhere below. Our buy order is above R1, which is above the moving average. So that's good. So you can see here with the pound dollar that I did, again, this is the moving average here, my buy order above the pivot point. So for example, here, let's just assume this is the market here, Abimbola. Let's assume that we went to trade around this point. You can see where the moving average is here, where my cursor is.
Yeah, yeah.
So at this point, if I want to place a trade, I won't be able to place a buy order just above the pivot because it would have been below the moving average. So at this point, the only place I can place a buy order would be R1 because that's the only place above the moving average.
Above the moving average.
But now that the moving average has gone below the pivot point, now I can place. In fact, I think, let me see, that actually happened some time ago on the platform. Let me see. It happened recently where I moved my order. Let's see if I can find it. Let's see if I can. It was recently. I remember moving my order because the moving average had changed. I can't find it. But I hope you get it. But it happened recently where I changed my pending order and oh, good. Oh, I finally found it. Phew. Okay, Abimbola.
Yep.
So I finally found it. So this is a good example. So you can see on this day, the euro US dollar, where is it? Okay. Let's start. So you can see assessing the live trade, the market has now moved halfway towards my profit target. I've moved my stop loss to the open level, blah, 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 to protect my capital. And I think, what happened? Oh, sugar, it's a different day. Oh my gosh. Oh, sorry, this is the card. This is the Euro card. The Euro card, okay, because I do two markets now. That's why I was confusing myself. I was looking at two markets. Okay, so with the USD card, when I assess the market here, at that time, you can see the moving average was above the pivot point. Isn't that right, Abimola?
Moving average was above the
Pivot point.
It's below the pivot point.
No, see, it's above the pivot point.
Oh, yes, sorry, yes.
Yeah, so at this time, I could only place my buy order above R1, isn't that right? And my sell order below S1, because the only pivot point line above the moving average here was R1. So that's where I put my buy order and the sell order is below. So that's what I could do at that time. But later on in the day, you can now see I was saying the moving average is now below the pivot point. Hence, I have now moved my pending buy order from just above R1 to just above the pivot point. Because you can see now the moving average has gone below the pivot point.
Right.
So now I moved it from above R1 to above the pivot point.
Okay.
So again, because you always want to make sure your buy order is somewhere above the moving average, your sell order is somewhere below the moving average. But again, it goes back to understanding that basic relationship between the market and the moving average. Because once you understand that relationship, then you can now apply it to your trading and what you're doing with your trading. Because like you say, the market and the moving average move in the same direction. That's why you can use the moving average to determine the trend of the market, because by looking at the moving average, you can tell the trend because they move in the same direction. You can use it as an opportunity to trade because you know the market is going up. If it crosses the moving average, it tends to fall, so you can sell. If it's falling and it crosses the moving average on the upside, you can buy. So again, that is what we use for swing trading. Let's go back to the charts. So that's what we're doing with the swing trading.
Right.
So you can see with the swing trade, that's what we're doing. The moving average market is falling. So I'm saying that if it reverses, breaks the moving average, I have a pending order there to buy to go up if it breaks it. That's what we're also doing with the USDCAD. It's currently trending down. So I say if the market changes direction and breaks the moving average, it tends to go up, not a guarantee. If it breaks it, then I'll buy. So that's why I have a pending order just 2 pips above the moving average. But of course, it changes every day. So that's why I keep modifying it every day and moving it 2 pips above the moving average every day in the morning. Check where the moving average is, adjust my order to 2 pips above that. Again, it's using this principle. So
you
that's
really
why.
use the moving average more for the swing trade.
Sorry?
I said you use the average more for the swing trade.
To trade.
For the swing trade.
No, I mean, do you mean to trade?
Yes, to trade.
Yes, to trade, yes. Again, in the past, I also use it for day trading. Actually, let's go back to that. I also use it for day trading, but what I remind people is that don't forget it's a moving average, so it keeps moving. So if you're going to use it to trade, and don't forget each of these candlesticks represents 5 minutes. So you need to be changing your order every 5 minutes in the charts, glued to the market all day till the market breaks it. So you cannot, for example, oops, what am I doing? Let me look for one. I want to look for a good example because most markets are currently trending sideways. Okay, but I mean, this is a good example. So you can see where the market is falling here. It's not a good example for now because this is about to happen. But let's assume this is where you started trading and you wanted to use a moving average to buy. That means you would have had to stay watching this market from 10 o'clock at night till now, moving your order every 5 minutes. Moving it every 5 minutes. Because there's no point placing your pending order above the moving average here and leaving the market alone. Your order will stay there and the moving average has moved. So you have to keep moving your order with it every 5 minutes until the market takes it. So unless you're sort of person, you're stuck at home, have nothing else to do, and you can be stuck in front of your computer adjusting your order every 5 minutes, then you can actually use it to day trade too. But I don't have that time. So that's why I only use it for swing trading, because I only have to do that once a day. I don't have to do it all the time. I just have to do it once a day. I just have to do it once a day with the swing trading because I'm using the daily time frame. So it's only once a day I have to make that adjustment. So that's why I only use it with swing trading. But yeah, technically you can use it with day trading, but you just have to be aware of the downside that you have to be adjusting your entry point, your stop loss every 5 minutes.
Yeah, that doesn't make quite sense.
Exactly. So that's why I don't use it. But I used to before, because obviously before I got involved with the charity work and my other businesses and stuff. Yeah, in fact, I used to live a very sad life before. because I remember before because like I told you, I started trading 20 years ago. So it was before I got married, before I was doing other things. So I was trading. I just used to go to work and trade. So I had a lot of time on my hands. In fact, at that time, I used to trade because with this Aussie 200, if you want to trade it, it's the Australian market. You have to trade it when the market is active, which means you have to trade it between midnight and 5 p.m. So this is how my life was very, very sad. Then I would be trading the Australian index market from midnight till about 4 or 5 o'clock in the morning, and also the currency pairs. Then I'll go and sleep between 4 and 6. I wake up at 6, quickly place my trade for the FTSE and the Euro US dollar. Then I go and sleep between 8 and 10. Then I wake up. Anyway, but yes, like you said, so then I had the time to be moving my orders with the moving averages and doing some crazy things because I could be monitoring the market. But of course, when I had other commitments, I had to stop all that. Couldn't do that. So yes, if you could live that kind of a lifestyle, Abimbola, go ahead.
No. That's not for me.
That's not for me too. So that's why I don't use it for day trading. So yeah, technically, yes, you can. Those same principles apply. For day trading. It's just that yes, you will have to be moving your order every 5 minutes till that happens, because you don't know when this is going to happen. So you just have to move your order till it happens. So that's yeah. But yes, the principles still apply for day trading. But yes, the downside is you have to be stuck in front of your computer, moving your order all the time.
Sorry, but Remy, isn't that why we place pending orders? So that I take it.
No, but again, that's what I'm saying. It's a moving target.
Yes.
So even if you place a pending order, let me go back to this. Okay. Let me actually use this as an example. So if you want to place a pending order here now, if you put your cursor on this candlestick, you check the moving average. So the moving average now is 70828. So that's 7083. So you're going to place your pending order now. Let me just make sure it's 10 cents in case it takes my order. So it's going to be 7083. So that'll be 7085. 20 pips stop loss. You still use the same 20 pips stop loss. So that'll be 7065. And then your 60 pips profit limit, but I will calculate that later. So let's just place it. So now you have your pending order 2 pips above the moving average for this time period. Now, this is a pending order, correct, but in 5 minutes time, this moving average figure will change. Maybe we'll wait for 2 minutes and see what happens. So it will change in 5 minutes time. So if it changes and you don't change your pending order, it will be hanging around here. And then the moving average will be getting lower and lower. And then when the market breaks the moving average, it will now take your own order at the wrong place. So that's what it means, that this pending order is pending order for where you've placed it now. So, and that's why the pivot point is good, because with the pivot point is a fixed point from midnight to midnight. So that's why you can place your pending order with a pivot point and switch off and go away. So that's why it's good. You don't have to monitor it all day and be glued to your screen all day. Because this pivot point level, this level of pivot point of 0.71499, it will be 0.7199 from midnight to last night to midnight tonight. It doesn't change. R1 doesn't change. S1 doesn't change. S2, they are fixed. It's not a moving target. So that's why it's good. The pivot point, you can just place your pending order and leave it alone. Just like we've done now. The market has finally taken my buy order for the pound dollar. So that's why we can do that easily for when we're trading using the pivot point strategy. You can just leave your order there and forget about it till the market takes it. But you cannot do that with using the moving average, because again, that's why it's called the moving average. It keeps moving. It's moving. Okay, you can now see it's now 7:35. It's now got a new candlestick moving. You can now see the moving average now is now 0.7083. So you now have to adjust your order to 7084. So you have to move it now to 7084. Adjust your stop loss. So you have to do that every 5 minutes. As the moving average is changing, you have to keep changing your pending order. And like I said, well, I don't have the time to do that because once this call is over, now I'm going to have my breakfast and do something else. So I haven't got the time to keep. But yeah, if you've got the time to do that, but yes, that's the key, Shagun. It's a moving average, so you have to be moving your pending order every 5 minutes till the market breaks it and takes your order. It's the same with, but that's why I say I only use it for swing trading, because that's what I do with the swing trading. I move that order every day, but because it's swing trading and I'm using the daily time frame, I just have to adjust that order once a day every morning. But yes, if you're now day trading and using the 5 minute time frame, you have to adjust that order every 5 minutes till the market takes your order. I hope that makes sense, Shagun.
It does. It's quite
Okay,
clear.
brilliant. Okay, any other questions? Are you good with that, Abimbola?
Yes, thank you very much.
Brilliant.
Really, really helpful.
Brilliant question. Really helpful question.
Thanks. Like I said, that's the aim of these sessions. It's
Very
number one,
good question.
well, number one, I'm getting old, so I can't remember everything to tell you guys. So the questions always help. Yeah, because like I said, I planned to talk about gaps and I completely forgot. And I'm thankful Abimbola reminded me. So yes, like I said, that's the whole aim of this
Being your
session.
memory to deal.
Yes. So yes, like I said, that's the whole aim of this session, is for this question and answers, to ask all these questions. And obviously when we see different scenarios like the gap that happened yesterday, it's always a teaching tool. Okay, so if there are no questions, I think we've done enough for this morning. So we've already placed our orders. We'll see what happens in the market and we'll catch up on the platform.
Okay, thank you very much.
Pleasure.
Thank you, Remy. Thank you.
Pleasure. Have a nice day.